Hey everyone, my name is Addy, and I have been trading short options or short side of the options for the last 10 years. I would say maybe roughly 10 years. During these years, I've been trading short volatility strategies, short Iron Condor, short credit spreads, basically anything to take some advantage of high volatility in the market and collect theta or premium decay in these strategies that I am going to show you. Today, we are going to talk about the Iron Condor strategy. I have talked about the credit spread strategy a lot in the past, but today it's all about Iron Condor and how to generate some monthly income trading Iron Condor strategies on any of the underlyings. Now, I would like to show you an underlying market or the ticker that I like. I already have some. This is my paper trading account, so I sometimes hold some stock in this just to for example purposes. When I make these videos. So here I am in the Apple stock. Actually, I like the S&P 500 futures market better because it provides better leverage and better capital efficiency, meaning you can collect more reward for your risk. So I like to trade this market more than versus stock or ETFs. And therefore, I'm going to show you an Iron Condor strategy in the S&P 500 futures options market. Okay. If I were to take a trade right now in the indices, in any of the indices right now, I would go to this one, S&P 500 futures, because it is the most liquid and most efficient market out there compared to NASDAQ, Dow Jones, or Russell 2000. So let's take a 32-day trade here. If I were to trade an Iron Condor, a 30-day Iron Condor, usually I go 40 to 45 days out. But today, given the whole market turmoil outside, whatever is happening in the world versus what's going on in the market doesn't seem to care much because the S&P 500 futures are trading at 6094, meaning around roughly 6100. This was their monthly trading range, 67 points, which it's already up in a day. So it has already gone one standard deviation move already today. So if I were to take a trade right now, I would go, Iron Condors are basically selling the put spread and then you're selling the call spread and you're being delta neutral. That's the whole game here. You don't take any market direction. Yes, the market will eventually give you a direction when it goes up or down, but your main target is to collect theta or premium decay in these strategies. Okay, so let's start with this. I would right click on a 17 delta option on the put side first. And I would sell an Iron Condor here. When the setup comes up, my go-to number of contracts are just one, just to begin with. Now look at this put side first. We sold it at 57.50. We will buy it at 57.25. So that's already set up for us. 25 points wide, totally fine. The next one is to set up the call side. Now the call side, I'm getting one 19 delta one, and the other one is 16. So I'll take the 19 delta. Look at the open interest and look at this column. The open interest and volume columns. These are the two main things I look at. Very liquid because there's high open interest in all these strikes. There's low volumes, not much volume here, but overall it looks really liquid. Same on the put side. If I were to check the put side here, go up. The open interest is in thousands. So I'm going to take a position on the call side now. I'm going to take the 19 delta short strike. So I need to change this to 6,300. Let's go down, find the 6,300 strike, which is there. And then I'm buying the one above it. So the one next to it is 63.25. So that's the strike I'm going to buy to complete the Iron Condor setup. And look at the amount of credit I'm collecting here. So first, let's look at the analyze tab, see how the chart looks. This is how it looks. The first thing you need to do here is change the break-even points. Make sure the break-even points match your calendar date. So 7/19/25 here. Just make sure it matches here so that you get the right chart. 7/19, which is here. Okay. So on the upside, you're not covering the whole one standard deviation move because there's obviously more put skew than call skew. So on the put side, you usually do cover the one standard deviation move, which means the gray area is usually covered on the put side. But on the call side, you have to go further out of the money because there's a positive drift here in the market, meaning there's more risk on the upside. Okay. Net, you're collecting $337. Look at the bottom left side here in the teal number when I hover over, 337.5. And then my net loss or my net credit, my net risk in this trade is $912.50. So that's how much I can lose, and this is how much I can make, 337. Okay, so it's like 3-to-1 risk reward ratio, which is totally fine, perfect setup. You're putting down $647 to initiate this trade. Now, if you were to initiate this right now and you did not have to make any adjustments and did not have to make any put any more margin in, that means you are collecting 1-for-1 or at least 2-to-1. So collecting 337, you're only putting down 647. So if you were to do this trade in a stock or on an ETF, if you were to collect $337, you would be putting down three times as much money as you are here. So instead of 647, you would probably be putting down $1,800 to $2,000 in any other ETF or a single stock option. I can show you that as well. But anyway, to complete this trade here, you're getting charged $9 because there are 4 legs now. And this number is not really true because in my real account, I get charged a little bit more. This number would have gone up to like about $15 each way. So 15 each way, so that's $30. So take out 30 from here, your net credit, it would have been like maybe $300. Okay. This is the basic setup of an Iron Condor in the S&P 500 futures market. Let's confirm and send it and try and book it in. Let's see if you get this trade in. If not, we'll keep working. This is a working trade, I think. It comes up here in the working order list. So it looks like you have to like reduce the price a little bit because it's trading at 650 now instead of 675. Well, no, it's actually trading at 675. So I'm going to use 650. Oh, that's it. It went in. So it got filled for 6. It got filled for 7. How much it got filled with? Wait a second. Auto filled for 725. That's great. So I got filled for 725, even though I was in with like 675, offer there. But I got filled for 725. So that's great. So my net credit now, my overall credit, if I have to like look up on the chart, is around $362. Before it was $337. So that's the difference. You got bumped up probably $25 here in this trade. Now, how to manage this trade? Now, when you go in as an Iron Condor, you got to come out as an Iron Condor, but sometimes that doesn't work. So if the market moves either way, one side or the other, I would take that side off and keep the other side on and roll that side. So roll the untested side either in the same expiration cycle or the next one. So that's how I would roll this when I'm done with this. Okay, any questions, just please let me know. I will be making more videos on other strategies and other stuff, everything option selling, whatever knowledge I have, I'm going to dump it down here in these videos. One thing I want to take you guys through is like I'm running a 5-day trading challenge starting on July 7th. It's a 5-day course and we will cover everything in detail. So everything that I've shown you here, say 10 times more than that, we will cover that in these 5 days. So I invite you, I invite you to like take a look at this. I will put the link in the show notes. Take a look, see if it works for you, and then sign up. The first 10 signees will get a one-on-one portfolio review call with me before the challenge, or after the challenge each day. So I hope to see you there. Thank you very much. Bye-bye.